The crypto markets have been on an absolute tear over the last couple of weeks. We saw the total market capitalization of the crypto markets surpass $2 trillion for the first time in history. Now, while this is really exciting, it can be a daunting task to find both undervalued and high conviction plays in this type of market environment, especially if you're a newcomer to the space. So with that in mind, what I'm going to do in this video is cover 4 crypto projects that I can reasonably determine are still undervalued and that I have high levels of conviction in. And being a student of Buffett and Munger, I appreciate the importance of having both high levels of conviction and a strong understanding of the underlying economics of each investment decision that you make. So with that in mind, what I'm going to do for each of these plays is I'm going to cover what the project does, why I believe it's undervalued, and where I see it going for the remainder of this crypto cycle, as well as where I see it going in the long term. So with that, let's get right into it. The first token we're going to take a look at is an exchange token that has outperformed Bitcoin by an incredible degree. If you had bought this token at the beginning of the year, you would have outperformed Bitcoin by over 700%. Now, this token was only introduced in 2019, but since then it's grown over 50x due to the incredibly strong fundamentals that are backed by the underlying performance of the exchange. Now, the utility of this token comes from the numerous benefits that owners of the token have on the exchange. These benefits include fee rebates based on the amount of the token that you own, as well as staking rewards which increase based on the amount of the token that you've staked. These staking rewards include increased referral rates, maker fee rebates, bonus votes on polls, free daily ERC20 or ETH withdrawals, and relative increases in airdrops. Now, these benefits stemming from the utility of the token incentivize traders on the platform to buy and hold on to the token, which represents the first form of demand for the token. But the long-term investment performance of the token is driven by the economic utility of holding onto the token and is generated by the token's value accrual mechanism. Value accrues to this token because 33% of all fees generated on the platform, 10% of net additions to the exchange's insurance fund, as well as 5% of all other fees generated on the platform are used to buy and burn existing tokens on a weekly basis. In essence, what this buy and burn mechanism does is it gives the token similar characteristics to a royalty payment. And the way that I've come to look at this token is kind of like a royalty income fund, except instead of being paid the royalty in the form of a dividend, the way that most royalty income funds do, you're being paid the royalty through a mechanism similar to a share buyback program. Now, by now, some of you have probably guessed that the token I'm talking about is FTT, which is FTX's native exchange token. Now, I've made a previous video on FTT where I go more in depth on why I'm bullish on FTT and what I think is going to drive the investment performance of the token. So if you're looking for more in-depth analysis, you should check that video out using the link in the description. As it stands today, FTT is trading at a market cap around $7 billion, and with the most recent weekly buy and burn coming in at around $4 million, this means that the token is trading at an annualized yield just above 3%. Now, while this 3% figure seems relatively low, this is because future growth expectations have been built into the price of FTT. Now, I think that these growth projections that have been built into the price are reasonable given the growth and volume that we've seen on the platform over the last few months. When I originally bought FTT back in January, the volume being conducted on the exchange was somewhere around $4 billion. And today it's already up to over $16 billion. Now, I not only think that this volume is going to be sustainable into the future, but I think it's going to grow at a pretty rapid pace for the rest of 2021. And there's 2 reasons why I think FTX is going to be able to not only sustain, but grow the amount of volume on their platform. The first reason is stemming from volume trends that we're seeing in the crypto markets as a whole. I think the best way to highlight why this volume is going to sustainably increase over the next year and into the future is by taking a look at volume trends in the crypto markets as a whole over the past 5 to 6 years. And we're going to do that by using the moving average of volume. Now, if we take a look at the moving average of volume back in 2015-2016, the moving average of volume was somewhere around $30 million at the beginning of 2016. Now, as we move forward into 2017 adoption cycle, we see that the moving average of volume peaked all the way at $20 billion of volume transacted each day. This represents close to a 1000x increase in the amount of volume transacted in the crypto markets in just over 2 years. Now, even if we take a look at the amount of volume that's being transacted in around the mid phase of the adoption cycle, the moving average was sitting at around $3.8 billion. And by the end of the adoption cycle, we saw the moving average of volume bottom out at around $13 billion transacted each day. This means that volume sustainably increased by over 3 times from September of 2017 to September of 2018. And I think that we're going to see a similar tripling, if not more, in the amount of sustainable volume in the crypto markets. And I think FTX is going to be able to attract a proportionate share of this increase in volume, if not even more. Now, the second reason why I think FTX is going to be able to sustainably increase their volume is because they're going to continue to take market share away from larger and smaller competitors. And like I said, in the past 4 months, the volume transacted on the exchange has risen from $4 billion to over $15 billion a day. Now, this in part is being led by the adoption of cryptocurrencies by retail traders all over the world, but it's also because FTX is taking market share away from their competitors like Binance and BitMEX. And on top of that, I think that FTX is going to be able to attract a lot of trading volume from institutional traders who are going to be entering the crypto space over the coming years. After all, FTX is led by a team of quantitative traders, and they have a lot of connections within the space. So I think that they're going to be able to attract a lot of institutional trading volume to their platform, and this is going to help them continue to sustainably grow the volume transacted on their exchange and subsequently increase the size of weekly buy and burns. So I think that there's a reasonably good chance that FTX is going to be able to grow the volume on their platform by 4 times, if not even more, by the end of this year, which is going to drive the yield of FTT up to 12% if the valuation stays the same. So if this happens, I'm expecting this to push the price of FTT up to around the $150 to $200 range, which means that it has another 3 to 4x left to go. So for that reason, FTT is one of my favorite plays in the crypto markets today. This next token is solving one of the biggest problems facing the cryptocurrency industry, which is the interoperability of blockchains. Or put another way, the ability to shift liquidity across blockchains with relative ease. Now, this protocol has created a decentralized solution to this problem that is more scalable, more widely applicable, and more trustworthy than its current competitors. Now, this protocol has been able to do this by leveraging the commonly used tokenized representation model, which you may be familiar with from things like wrapped Bitcoin. But the difference between this protocol and wrapped Bitcoin is that it doesn't use a centralized custodian that requires permission. It's a decentralized protocol that is permissionless, and the integrity of the network is maintained by node operators called dark nodes. Now, the way that this network works is that dark nodes are randomly arranged into larger groups called shards, and these shards then take custody of a specific asset, and they mint a one-to-one pegged representation of the custodied asset on a destination chain. So for example, if you wanted to use your Bitcoin on a DeFi application built on Ethereum, what you would do is you would send your Bitcoin to be custodied by one of these shards, and the shard would then issue a one-to-one pegged representation of that Bitcoin on Ethereum in the form of an ERC20 token. The user would then be able to take that ERC20 token and use it on any DeFi application that accepts that token. So the protocol that I'm talking about is the Ren Protocol, and the protocol's native token is the Ren token. Now, to understand what's going to be driving the investment performance for the Ren token, we have to take a look at the 2 primary demand drivers for the token. The first comes from the fact that in order to operate a dark node, you must bond 100,000 Ren tokens to your identity. And this bond acts as a commitment to good behavior by the dark nodes, because if a dark node ever loses or steals custodied assets, the protocol slashes that dark node's bonds and uses its Ren tokens to buy back the lost or stolen assets in order to always maintain a one-to-one peg. The second demand driver for the tokens comes from the value that is being accrued by dark nodes. Now, because dark nodes are taking on a risk by custodying these assets, they have to be paid or incentivized in some way to take on that risk, and the way that the protocol achieves this is by paying dark nodes a transaction fee for every mint or burn transaction that they conduct on the network. And this is how the value accrual mechanism works for the Ren protocol. While value doesn't accrue directly to the Ren tokens, because dark nodes have to bond Ren tokens to their dark node, and value accrues to the dark nodes themselves through transaction fees, we can indirectly determine what price a dark node would be willing to pay for Ren tokens in order to make the price paid for the Ren tokens worth it to operate that dark node. There are currently 1,774 dark nodes operating on the protocol. And since the supply of Ren is fixed at 1 billion, this means that 17.74% of all tokens are bonded to dark nodes. In the last epoch, dark nodes earned $1.5 million in transaction fees, and with Ren tokens trading in a range around $1, this means that each dark node is trading at an annualized yield of approximately 8%. Now, an 8% yield isn't anything to get excited about. I think it's a pretty fair return, commensurate with the amount of risk that their dark nodes are taking on. But why I think there's so much room for growth for Ren is because currently the only destination chains enabled by the protocol are Ethereum and Binance Smart Chain. But in the March development update, the team revealed that they're going to be launching Phantom and Solana as destination chains when the new version of mainnet goes live. Now, why I think this is so important is because this is going to attract a lot more volume to be minted on the network. And the reason why is because now there's going to be a way to efficiently bridge DeFi on Ethereum, Binance Smart Chain, Solana, and Phantom. And this is going to create a lot of arbitrage and yield farming opportunities for market participants who use RenBridge. And I think what this is going to do is going to kickstart the network effects around Ren Protocol. Because as more volume is minted on the network, this is going to encourage more DeFi applications to accept Ren Protocol's tokenized representations of assets on their smart chain. And as more DeFi applications start to accept Ren assets, then that's going to increase the amount of volume that is transacted on the network. It's going to increase the transaction fees earned by dark nodes, which is going to lead more dark nodes to join the network, which is going to drive the demand for Ren tokens up and also push the price of Ren up. Now, this is exactly why I think Ren is going to be one of those plays that goes really slow and then just happens all at once. And I think it's because the network effects have been building out very slowly, but as soon as they take hold, Ren is going to just go on an absolute tear as we see the volume minted on the network rise extremely rapidly, driven by the fact that more DeFi applications accept Ren tokens and because Ren is integrating with more smart contract chains. So that is why I'm bullish on Ren and why I think it's a sleeping giant that's going to absolutely explode in the later half of this crypto adoption cycle. Now, moving on to the next token, if you're a big fan in Ethereum and you think Ethereum is going to be performing well for the remainder of this cycle, then you're going to love this next token. This protocol is solving one of the biggest problems facing Ethereum, which arises from Ethereum miners leveraging their position to extract almost all of the value from any liquidation or arbitrage opportunities that arise on-chain. They do this by either accessing the information stored in mempools and reorganizing or reordering transactions within blocks, or they simply allow on-chain profit seekers to battle it out over gas prices. But what ends up happening is that miners on the Ethereum network take home almost all of this value, which is referred to as miner extractable value, and Ethereum users get shafted with high gas fees. Now, to solve this problem, this protocol has come up with 3 game theoretically optimized games that have aligned the incentives of DeFi users, on-chain profit seekers, and liquidity providers to create an alternative system for order and loan routing, which allows profit seekers to maximize their profits, DeFi users to get the most efficient executions, and also for liquidity providers to passively earn income for pooling their assets. Now, the protocol that I'm talking about is KeeperDAO, and its native token is ROOK. And if you're interested in learning more about KeeperDAO, because it's honestly one of the most fascinating protocols I've learned about, you can check out one of my previous videos where I go over KeeperDAO and my investment thesis regarding its native token, ROOK. Now, a brief overview of how this protocol works is that it allows DeFi users to route their orders or loans through specialized smart contracts on KeeperDAO. Keepers, who are on-chain profit seekers within KeeperDAO, are then given priority access to these transactions, which are hidden from miners, and are able to extract maximal value from any arbitrage or liquidation opportunities that arise from the orders and loans routed through these smart contracts. Keepers use assets that are pooled by liquidity providers in order to take advantage of any of these opportunities. And any profits that keepers extract are then taken and returned to a treasury, which is cumulatively owned and controlled by ROOK token holders. In order to incentivize keepers, liquidity providers, and DeFi users to join this system, they're all rewarded for taking part in these games with ROOK tokens. Now, the utility of the ROOK tokens comes from the fact that it's used as a reward to align the incentives of all of the different users that are playing these games, and in addition to that, the ROOK token is a governance token that allows holders to vote on changes to the protocol. Now, the economic incentives behind holding the token comes from the value held in the treasury. Now, as it stands today, the ROOK treasury is valued at $69 million. And with 1.1 million ROOK tokens in circulation, this means that each ROOK token is backed by $60 held in treasury. And with ROOK tokens trading at $550 per token, this means that 11% of each ROOK token is backed by economic value held in the treasury. Now, my investment thesis regarding ROOK tokens is that ROOK tokens are trading near fair value when around 10% of each token is backed by value held in the treasury. And the reason why is because the ROOK governance can decide to pay out the value of the treasury to ROOK token holders in the form of a dividend or using some sort of buy and burn mechanism, which mean that the yield on ROOK tokens would be at around 10%. And I think that this is a very reasonable yield given the risk you're taking on by investing in ROOK tokens. Now, the investment performance of the treasury is going to be driven by 2 things. The first is the investment performance of the actual tokens being held in treasury, and around 75% of those tokens being held are Ethereum, which is why at the beginning of this section I said that if you're bullish on Ethereum, you're going to love this protocol. And the second driver of investment performance is going to be the continued addition of profits to the treasury by keepers. The combination of these 2 factors is why I think ROOK tokens are going to outperform Ethereum for the rest of this cycle. Now, before I wrap it up with ROOK, I think it's important to note that a lot of people have been speculating that EIP 1559 is going to be detrimental to KeeperDAO. Now, what EIP 1559 is a proposal on the Ethereum network that would make it so that miners no longer get paid gas fees. Now, this actually makes me a lot more bullish on KeeperDAO because what this means is that miners will have lost a revenue source and they're going to have to focus a lot more of their time on miner extractable value by reorganizing blocks or reordering transactions. And this is going to make it a lot more challenging for on-chain profit seekers that aren't a part of KeeperDAO to extract arbitrage or liquidation profits on-chain. And this is why I think that if this proposal passes in July, as most people expect it will, it's going to drive more keepers to join the KeeperDAO ecosystem, which in turn is going to drive more DeFi users to route their orders through KeeperDAO because they can get more efficient executions. And this is going to drive the profits being generated by keepers on the network to increase, which is going to cause the treasury to also increase at a much more rapid pace. So this is why I'm bullish on KeeperDAO, and I think that EIP 1559 is actually great for the protocol, and I'm excited for it to go live in July of this year. So that is why I think it's going to outperform Ethereum both in the short and long term. Now, in terms of a profit target for this crypto cycle, I think that a reasonable price target for KeeperDAO is somewhere around $2,000 a token. And the reason why is because I expect Ethereum to at least 3x by the end of this year and reach a price somewhere around $6,000 to $7,000. Now that alone would increase the value of Rook's treasury by 3x, and on top of that, I think that keepers are going to continue to add profits to the treasury, which is going to increase the value of the treasury even more. So I think that by the end of the year, it's reasonable to assume that the KeeperDAO treasury, if it continues to grow at this rate, is going to reach a value of around 200 to 300 million at least. And because the value of each Rook token can be derived by the value held in treasury, I think that Rook tokens are going to grow proportionally to the increase in value held in the treasury. And because of how consistently keepers have been adding value to the treasury, I think that this is one of the highest conviction plays I have in the market today. And now we're going to get into the last asset we're going to talk about in this video, and of course, it's Bitcoin. Now, if you're just getting into the crypto space and you're looking at that exponential Bitcoin chart and seeing it trade at $60,000, you might be thinking that you missed the boat or that it's too late to buy Bitcoin. But I don't think this is the case at all. And the reason why is because Bitcoin has the strongest network effects built around it out of any asset in crypto and arguably any technology that exists in the world. And it's also the asset that institutions are currently focused on and pouring billions of dollars into every single week. And I don't think this trend is going to be stopping anytime soon. I mean, just this last week, we saw Goldman Sachs CEO come out and say that he thought that it was inevitable that Bitcoin's market cap was going to pass that of gold's. And with Bitcoin trading at $1 trillion market cap and gold sitting at around $10 to $12 trillion, this means that Bitcoin still has more than 10x left to go. And even further than that, I think that as Bitcoin becomes accepted as a form of financial collateral and starts eating away at the market capitalization of bonds and real estate, it's going to eventually become a $20 to $100 trillion asset. So even if you're buying Bitcoin today, you should be buying it with the long term in mind and not looking at it as a speculative bet for the remainder of this year. And if you do hold on to Bitcoin for the long term, I think that you're very likely to make a lot of money. Now, why I like Bitcoin more than all of the other projects that I've talked about and why I still have around 85% of my portfolio allocated to Bitcoin is because of the incredibly strong history that Bitcoin has behind it. And this history is what I think makes Bitcoin irreplaceable. Bitcoin is really unique in the sense that it kind of just emerged out of nowhere. An unknown person or group of people created Bitcoin and just kind of posted it on an internet forum. And from there, Bitcoin self-propagated itself to become a $1 trillion asset. And Bitcoin did this without the help of any VCs or large institutional backing. And I think that that's what makes Bitcoin so powerful, is that it did this all on its own. In that sense, it's kind of like a financial singularity, in the sense that it's been able to suck in billions and now trillions of dollars into the protocol. And at the end of the day, when you're making a decision whether you want to buy Bitcoin or not, the decision really comes down to a pretty simple question. And that's, what type of monetary policy do you believe in? Do you believe in inflationary monetary policy that is centrally controlled? Or do you believe in deflationary monetary policy that is governed by mathematics and code? I think there's a pretty simple answer to that question, and it's the deflationary monetary policy that is governed by mathematics and code, because you know that you can trust that code. Now, by the end of the cycle, I think Bitcoin reaching $100,000 is pretty much inevitable at this point, and I can even see a scenario where it goes even higher to $300,000, $400,000, $500,000 US if the super cycle theory does end up playing out. But at this point, just buying Bitcoin today at $60,000, I think you're going to at least double your money by the end of the year. And that's why I think that Bitcoin represents one of the best risk-adjusted returns even for the rest of this cycle. But also, if you're going to be holding Bitcoin for the next 5 to 10 years, I think that the return potential on Bitcoin is still another 10, 20, maybe 30x. So that does it for this video. I hope you guys enjoyed, and I look forward to seeing you all in my next video.